you all doing? This is NKD Trade Zone. So on today's video, I'll be taking you on the perfect risk management system. The perfect risk management system. Now, before we go on to speaking about that, I believe you are very much aware of what we have on screen here. This on screen is actually the risk to reward system on the Trading View platform. So as a trader, you should know that whenever you're going in for a trade, as much as you consider what you want to make from that trade, you should also consider, most importantly, what you are willing to risk on that particular trade. In that sense, now on screen here, we have a risk to reward of what? 1 to 3.93, meaning that if you are risking $100 on this trade, you would be looking in to make $393 on this particular trade. Most traders are always much more concerned on this $393 than the $100 that they'll be risking in. And on today's video, I'll be talking about how to make a fixed system for your rewards. In this system now, you'll be able to curtail how much you'll be losing per day, and it's actually going to do you much more good because you'll be much more strict with your account drawdowns and also your reward system. So before we go on to that now, look at this on the screen. We have a risk to reward of 1 to 3.93. Most times traders are always so concerned about how tight is their stop losses, which means that at the end of the day, they want a reward system that is rather so tight, forgetting the fact that what actually matters in trading isn't all about a tight stop loss, but rather how consistently do you win. It's better you do this, a system whereby you have this 1 to 2. You're risking, let's say, $100, you're making it $200. Then when you're looking in for what? 1 to 8.5, at the end of the day, you risk $10 here for $80, and most of the time you might get stopped out. So it's not all about how tight your stop loss is, it's all about what? The consideration towards consistency. Better to do this than to look in for this all the time. Yes, this can actually work good, but most of the time you can eventually find yourself in a sweep, which means that before this big move will come in here, you are out of the market already. So don't always find yourself in such a situation whereby you need what? A tight stop loss. Look at this on screen now. Let's give this value of 1 to 8.5. You're risking $10 here, you are making what? $85 here. Now let's say you choose to do this much more safer, 3.8. You're risking the same $10 here, you are going on what? 3.8. On the long run, this is actually going to benefit you more. That is something you should note. Rather than doing a 1 to 8.5 in this given sense now, do what? 1 to 3.8. Increase your risk factor. That means rather than what? A $10 here, do a $20. So a $20 on 3.87 will be giving you around what? We can speak of 7.6 thereabout. You do understand me? So $20 for $76. So that is actually what? A structure you can build. So it's not all about getting what? The tightest stops out. No, most of the time that just subjects you to excessive stop outs in the market. Now, this is not the main case study for today's video. Let's go over to the main case study for today's video, which is what? Building the absolute risk management system on a fixed reward. Now, to do this, I'll be making use of my notepad as well as a calculator tool for calculations. Now, let's do this. Let's say we do have a $100 account. So starting up amount on this account is what? $100. Now, you can decide to be a trader who takes not more than 5 trades per day. So nothing more than 5 trades per day. You can actually what? Be that stable. And in that sense, now you can build up a system whereby every of your profit target is fixed. I'll be explaining that as we start up on these calculations now. So let's say you woke up in the morning. Today is a good Friday morning. Then you're up and you have decided that as my trading strategy, number one, I don't take more than 5 trades per day. And number two, I want a fixed profit ratio for every single hour to hour I take. That means whether the hour to hour will be 1 to 2 or 1 to 10 or 1 to 50, this is what I want it to be. Now on a $100 account, you can decide that for every single trade you want to take out $10. That is not necessarily something that you have to do. You can't be risking 10% of your total capital on a single trade, but let's do assume that that is what you want to do. Ideally, it is not right. You shouldn't risk more than 2%, 3%. But as a trader, you should know that whenever you have such a small account like $100 account, you cannot really follow risk management. Though it is essential you do so, but most traders would not. Risk management is actually associated with the bigger account, the larger ones, $1,000, $10,000, $100,000 account, not what? $100. So let's assume. Now, to use the system, first thing you have to clearly define is what is your risk to reward for a 1 to 2. So how much do you want to risk for 1 to 2? If it's what? $10 to make what? $20. That means it is clearly defined at this stage. You know what you want to do. $10 what? For $20. Now, this $10 is what is much important, because this is what you use for your calculation following up from here. Now, let's say you do get on your first trade. Now, what you want to do is to make sure that you clearly define, as I showed you in the beginning of this video, your R to R. So your R to R, the risk is always 1 to the value of the reward, which, let's say for our first trade, is 3.7. So what we want to do now is to what? Clearly define this by calculations. So let's take out our 3.7, get over now to the calculator. So now we have what? 10. As I told you from the very beginning, you've defined what a 1 to 2 risk to reward ratio is. It is important to define what a 1 to 2 risk to reward ratio is, because that calculation, you would always use it. So once you get your risk to reward for 1 to 2, this is what? For the 1, which is $10. So what you want to do here is $10 divided by, so we are using a risk to reward of 1 to 3.7 here. So 1 to 3.7, then you what? Do this, then you do times 2. So we are risking what? $5.4. Now, one thing to note is the fact that what is important here is what? Not this $10. $10 is our parameter for calculation. What is important is this $20 here. This is what we are targeting by every single trade. Now watch this. 1 to 3.7 means that we should risk what? $5.40 here. So let's state that in 5.40. Then we are to what? Profit what? This is where the magic happens. Now do this 5.40 times 3.7 once again, times 3.7, and you are back to $20. So you can see this here. So what this means is the fact that on every single trade, we are targeting what? This $20. So we do this, risk $5.40, reward $20. Now let's get on now to our second trade. So the sum risk is always fixed 1 to, let's say our second trade now has what? 4.2, 1 to 4.2. So what we have to do now here is the same thing. Go over to your calculator app. 10 divided by 4.2 times 2. That means you have to risk $4.76 on the second trade. So this is it here, $4.76. And what are you going to make? Times what? 4.2, as we earlier stated, times 4.2. You're back to $20 on the dot. So $20 is what? Your reward system. So this now gives you a fixed reward system. That means for every single trade you are taking, you know that what you are targeting is that $20. That $20. This is actually a risk management factor that stops you from being flexible on your trades. Now let's get on to the third trade here. We do this. Risk is always 1. Reward for this could be, let's say, 5.7. So we get on for this. Then we do 5.7. So we get on now to our calculator. 10 divided by 5.7 times 2. So we have to risk $3.5 here. So we are risking out $3.5 for this trade. And we want to earn what? Let's see if it's also fixed. Times 5.7 times 5.7. Also $20 right about here. So you do understand this is actually a fixed system that will always hit out what? $20 at the end of the day. So let's say our fourth gameplay now is gonna be a trade of 3.21. So let's say 3.21 at this stage. You do 10 divided by 3.21. You have yourself 3.11 times 2, that is 6.23. So 6.23 would be what? Put in as your risk factor, then times 3.21, you have yourself back to 20. So you have yourself what? Back to 20 here. Then for the fifth, right here, let's do 1 to, let's go something higher. 7.18. So 1 to 7.18 here. All right, so 1 to 7.18. So we do 10 divided by 7.18 times 2. So you have 2.78. For this, you are risking quite low, 2.78. That was what I stated in the beginning of this video. When you are going in for a high R to R, you always tend to use, or you should always tend to use a smaller risk factor in it. You cannot be risking 1 to 3 the same you are risking 1 to 2 the same you are risking 1 to 20. It's bad for the account. It's always unhealthy for the account. So let's get this on times 7.18 times 7.18. You're back to $20 here. So $20 here. So as you can see right now, we have our total 5 game plays. A disciplined trader would follow this up. So let's get on now to today's calculation and see how much we are risking in total. So for this, you have your 5 game plays settled, a $100 account, 5 trades. Risk to R was stated at 1 to 20. This is your trade 1, trade 2, trade 3, trade 4, and what, trade 5, and you are done for the day. Maximum of 5 trades for the day. So let's do this now. First things first, we want to do 5.40 plus 4.76. 5.40 plus 4.76 plus 3.5, which is your third trade, plus 6.23, which is the fourth trade, plus 2.78. That's a total of 22.67. 22.67. That is what you are going to be risking out for the whole of the day. Now, mind you, whenever you initiate a trade, there's always a fee, a tax fee that your exchange is actually going to charge you for the trade. Now, depending if the funding rate is positive or negative, it depends how the rate is actually going to be charged at that given stage. A positive funding rate means that if you're on shorts, you'll be paying for the positions to be kept open. While if the funding rate is negative and you are buying, the exchange will be paying you to keep that position open. If the funding rate is positive and you are buying, you'll be paying the exchange to keep that trade open. If the funding rate is negative and you are buying, you are the one that will actually be paying. So that is the thing about funding rate. So whenever you are going in, you are not just paying fees to open and close the trade. Depending on how long the trade is running, you will also be paying fees. Sometimes the funding rates of some particular coins are so high, you are seeing around, for the negative side, minus 1 point. Ideally, funding rate should be quite on the 0.00 triple decimal places, 4 decimal places, for a much more stable coin at a particular period. But for one that is going through excess volatility, most of the time you will find it having an excessive funding rate. So keep note of that whenever you are trading, you also take note of funding rates. You can actually make some good profits. By the time it's time to close your trade, 4, 6, 7, 8 hours later, you find out that the funding rate is going to take out. In fact, it will completely eat your profits and you will enter a loss, despite the fact that your trade ended in profit. Because of the funding rates being too high, you end up in a loss when you close that position. So always do take note of your funding rate. So now we will not be considering the charges, the tax fee to open and close positions, or the funding rate. What we are going to be considering here is just our risk to reward factors. Those should actually be looked upon as negligible for now while we do this video. Following up with that, now we should go on for your reward. So maximum reward for the day is $100. That means we are risking $22.67, which is a total of 22% of our total capital, which is $100, for 100% maximum profit. That means if we should lose every single trade for the day, we are only going to be dropping down by 22% of this particular account, which is a $100 account. Why, if you win all 5 over 5 trades, you are getting yourself 100% into your profit. So this is actually a good setting, because if you win just 1 out of the 5 trades, you are getting $20. Let's not include charge, tax for opening and closing the trade, or funding fees. Let's just look in at your profit and loss margin. 1 trade only, 1, means that you are actually going to be minusing 20 from the 22, left with what? $2.67 in loss. You win 2 out of the trades, then you'll be talking much more about a plus 17.33 right about here. So you do understand me. All you need to do is to win 1 and you are almost going to break even, because most of the time when you are done with this calculation from your 1, 2, 3, 4 and 5 trades, you are always going to see yourself hanging around 20 something $30, which is around 20 to 30% of your total capital if you're looking at it this way. So as I stated, winning only one trade for the day means that you're almost going to break even on your capital. Winning 2 for the day means that you are surely in profit. So this particular system now gives you that idea into how to be rational while making your entries. You are not just being flexible, you have a defined system. It's not just all about your trading strategy. This is actually the best risk management that you can apply while trading. This is actually the absolute risk management system. All you need is one good trade for the day, and then you're almost going to break even on your account. 2 good trades in a day, then you are surely on profit. The reason why most people start up the day end in a loss is because they have no defined strategy. They have no defined risk management. They will make so many wins and they will end up in a loss at the end of the day because there is no defined risk system. Imagine whereby you trade 10 pairs for a day, or you have 10 entries for the day. You win 7 out of 10 and you are still in loss. You need to ask yourself what the problem is, and that is because there is no defined risk system that you are following. So this is actually, as I stated, the most definite, the defined risk system. You follow this up, and no matter how bad the day goes, you know that you are not going down more than 20-30% of your total capital. Number one, you have the opportunity to still stay in the game as long as you can. Now, for a professional trader, it's not all about what? A big win. It's not all about a lucky win, a lucky trade. It's all about staying long enough in the game to eventually be profitable. The longer you are able to hold on, the more chances you are that you are going to make something of it. If you get hit out on your very first try, then there is no opportunity for you to retry again. So the only thing you have to do is to make sure that you play the long game. Stay in the game for as long as possible, and only then can you finally hit that holy grail. So let's look into this now, as I believe I've explained all this completely as you should understand. The first step is define your capital. You should know how much is your capital. Then the next step is to what? Hold on to your daily trade limit. If it's 2, let it be 2. If it's 3, let it be 3. You are not trading for fun. There's no excitement in trading. It's all about making or losing money. So you should always clearly define every parameter. So first things first, you should know how much is your capital. Second, the following up with that, you should know how many trades you want a day. Is it 2? Is it 3? Is it 5? You don't exceed that by even half a trade. So whatever you are entering either you TP or you stop losses. There is nothing like break even, nothing like close. So you should be thorough with your analysis to make sure that you accept the fact that you are either going to TP or you are going to hit a stop loss. There is nothing like, I made this entry, it seems it's going against me, let me close. Then you are going against your strategy. Then you don't have a defined risk management system. So many stops out, it's okay, but so many closing, you always close out, will ridicule your system. You cannot build a system with that. So fear, panic, you keep out. You should know that your system is defined and you follow it as it is well defined. So I'm looking at that now. The first step, define your capital. You should know what you have at hand to work with. Second, you define your maximum trade per day. It should always be fixed. Why I did not say minimum trade, I said maximum, is because you are working with a max trade per day. Nothing like I'm working between 2 to 3, 3 to 5. No. If it's 5, it's 5. If it's 7, it's 7. If it's 10, it's 10. Doesn't mean you should fall straight. That is why I stated it at 5. Majorly in the crypto sector, if you are trading the crypto, you should know that getting 5 trades per day is not so hard. Even in the weekends, you can trade altcoins if Bitcoin volatility is low. So getting 5 trades per day is very much achievable. Rather than you not getting your 5 a day let's say you have to start late by a later period of the day, and you start forcing trades that are not there, you skip that day. So it's a thing of how did I begin the day and how did I end the day. So the third parameter is knowing what risk to reward you are using on a 1 to 2. So 1 to 2, you have to define it. 1 defines what you'll be working with your calculation. As you saw me, I did 10 divided by 3.7 times 2. So once you define what you are risking on 1, then you know what you're expecting on 2. So you must always use this 1 to 2 factor to place the basics of your calculation and your expectation. So 1 to 2 factor must always be defined. If you want it to be what? 50 to 100, you should know what to do. 50 divided by 3.7 times 2, you've gotten it. So you must always define what 1 to 2 should look to you. So once you are done with that, you can always move forward. So I believe I've clearly defined this, and this is how it is. All you need is 2 for the day to be profitable.